and welcome to this webinar on financial derivatives and risk hedging strategies for bank executives. We'll be delving deep into these topics with our esteemed speaker who brings a wealth of experience in the financial derivatives and risk management space. He is a former executive director of Union Bank of India and a senior mentor of Elite Bankers Club, comes out of a great deal of experience and knowledge. So again, I request Kalia sir to start his presentation. Over to Kalia sir.
There is a lot of terms which are used in financial derivative products. So derivatives are being used for that, as also for arbitrage opportunities also. Collateralized debt obligations. We will talk about that at a later stage. Instruments first, and then of course, depending upon the availability of time, I will also try to share. There are different variants of swap which we will be talking later. But basically, I thought, first of all, let me explain. All right. Now let's go one by one and try to understand and demystify the terminology that is used. A forward contracts are nothing but a deferred derivative instrument, right? Either you take a long position or short position. Taken a long position, he has taken a short position. What does that mean? A long position means the person is the buyer of the contract. What is the predetermined price agreed to at the time of entering into the contract? Right? For seller of forward contract, let's not confuse. Forward contracts are transacted between counterparties of exchange. Price discovery would be always more in future contracts as compared to future. Forward contracts have several variants. We will talk about that. Then we will come to futures also, right? Which is going to receive, say, 3 months hence. He wants to enter into a contract. What kind of contract it is going to be? In respect of the export that he is affected after 3 months, he's going to get. But this particular dollar exporter, whose example I was giving, if he would have got those dollars and sold in the market, he would have got for that 250,000 at the rate of 79. Notional. See, there is no actual. There is a notional because he has already sold. If you would not have entered into the forward contract, you would have got 82 rupees. But this depends upon the view that you have. And why people still go into these contracts, pay some amount and try to secure that unnecessary these price movements may not affect my overall business. They will, this is called what we call hedging, taking a hedging position. And hedging position is taken always on the basis of about the rupee, whether rupee would appreciate or depreciate by the, so you will take a long position in the contract, correct? And suppose he decides that the rupee may not go adverse or may not, because your banker or anybody would like to buy the foreign currency. All right. Bid ask spread, yeah, bid offer spread. That is the difference between the two prices. How bid and ask would be always. Now let's try to understand. Would you like to buy at a higher price or sell at a high price? Reliance Industries, would I like to buy at 2,500? Bid would be a lower price. Offer would be always, because you want to sell high and you want to buy low. A banker, it is the same. If he is buying foreign currency, he would like to buy low. And if he is selling foreign currency, he would like to sell high. Correct. So that is how the whole market bid and offer, and whatever is the difference is called the spread. The two things. Correct. Now, what are the future contracts? As I have explained to you, all future. There are, there is a currency futures, there is a equity future, there are commodity futures. We will discuss about them. So in future markets, there are currency futures available, there are interest rate futures available. That also, where the commodity futures are traded. Mostly commodity futures are in 3 segments: natural gas, energy products. So these are 3 segments in which currency futures and others. There is also an intermediary Clearing Corporation, right? No, if he wants to ask anything, I mean, let it be not. I would anyone see, let me, I tell you, this is otherwise a very dull and drab kind of subject. And stop me and let me ask your question. Because what is important is you should understand what is being talked about.
You can use the menu option raise hand so that I know you want to ask a question.
Ask
I'll give
question.
you an opportunity.
And know what I was talking about, futures. So I was talking first about commodity futures. These are what kind of exchanges where the commodity futures are traded. There are also for them also, intermediary which are clearing and settlement institutions, who are participants in the commodity markets. So there are different kind of, there is a trading and clearing member, TCM. There is an institution trading and clearing member. There are professional clearing managers, and there are only trading managers. So all of them have different roles. I mean, some of them can do the trades and settle that, but like trading members, they can do the trades on their own behalf, on behalf of their clients, but they cannot do any settlement. That has to be done through one of these institutions, which is ITCM or TCM or professional clearing managers. So we will not get too much into commodity futures. I just wanted to give you a flavor of as to how the commodity future markets operate. All right. But this is also all is standardized. Every contract would be standard. There will be common features available. Lot size would be determined. Everything would be there, right? So accordingly, these markets will operate. Now I will come to the equity features, all right, which is, which most of us are very familiar with, correct? Whatever is the adverse or positive, you will get the benefit or loss out of that on a daily basis in your account when you enter into a future transaction. Expiry of futures in national stock BSE is always the last Thursday, either buy or sell, depending upon the position that you have taken. In the futures operate differently because they are trading on the stock exchanges. And in futures, there is this particular feature of mark to market being done on daily basis. But whatever Reliance shares I wanted to buy at that particular price, at which I have entered into the future contract, or sell at whatever price I have decided to sell those. Similarly, I mean, there are currency features which are available within two pairs of the currencies of different economies have different, currency, Indian rupee, US dollar. You can have euro against US dollar. Those pair of currencies, they are also traded on the, depending upon the kind of view that you want to take. Currency futures market is there. Then there is interest rate future market. Now, when I am talking about interest rate future, first I should explain to you what is the forward rate agreement. This you must always remember in order to understand various types. Like I explained, there is no difference between forward and future. There is no difference between forward rate agreement and interest rate future when I will talk about that. One side of the contract called the long side, on the given amount in future, whatever is the notional amount, it can be 1 million, 2 million, 3 millions. Whatever is the given amount in future, you have to pay fixed. That one will side. Why I mean this interest rate future is always between a fixed rate obligation, somebody wants to convert into floating, or floating rate wants to convert into fixed rate. Because when we will come to interest rate swaps, then you will ask, what is interest rate swaps? A forward rate agreement or a interest rate future, particular payment that would be made interest rates. Except that, as I explained, future contract is exchange traded contract. You cannot have as per your specification. But in forward rate agreement, you can have as per your own specifications. Only thing is, it will have fixed term, for the notional amount would be fixed, length of the contract, expiry date, everything would be fixed. So that is something that we should understand. So, I mean, they are not illiquid. there would be hardly any secondary trades, forward market, but in future market, there will be lot many secondary trades that can take place. Bilateral, when you are doing where there is no intermediary like a clearing or settlement agency, then minimal, I would say. I cannot say zero, but it is minimal, right? Price discovery in a bilateral, what is the price discovery?
Please continue, sir. I have muted the fellow.
There is, these are always bilateral, and there is a common platform like NSE exchange or BSE exchange or Corporation Limited and DCCL. So these are kind of, exchanges on which the future contracts are traded, right? So commodity futures I have explained to you. I will not like to, unless until somebody wants to know more about commodity, but all lot sizes, weight sizes, everything is standardized and it is always available in those lots. But currently, as I explained to you, for agri products, gold, silver, as also for energy products like refined oil, crude oils, natural gas, etc. These are available for those kind of, and put option European style, that is YPL. But basically, they are call and put options, which are available in the market. Option buyer and option seller are different terminologies, or no obligation is not there, but he has a right. Why he has got a right to buy at that particular strike price? Somebody believes that Reliance share is going to go up. The two major participants, of course, there is an intermediary which I have told, which is clearing and settlement, but this is all done on the exchanges, right? By end of June, that is expiry date is always on last Thursday of the month. So whether it is option or whether it is, so you have taken, they are available in 3 months for 3 months period. That futures and options are available for 3 months period, right? This particular, I have taken a view that Reliance share is going to go to 4 contracts, 7 contracts, depending on how many contracts I have entered into. It depends upon that, right? And somebody wants to sell, I'll give him 3,000 irrespective of whatever is the price on that, depending upon where the stock price goes on that particular day. If suppose, now that brings us to the question, strike rate is less than the price quoted on the trading day, bought a call, he has bought a suppose call option. Call option means he wanted to buy certain underlying securities of Reliance. So if he is having a call option, that would be viewed. If he is having a where strike price is higher than the market price for call option, I am in the money is whatever is the movement that has taken place vis-a-vis the strike rate at which I have entered into the contract. Then definitely, as I said, I wanted to sell a put option. Then in that particular case, it will be of no use, but where strike price is lower than the market price for put option contracts operate in the market, right? They are also standardized, lots are there. Every instrument may not have the option. There are some standards features which would be available, and you can buy and sell the options. But of course, margin money requirements exchange have provided. Let's not just assume that premium if you are, but there is a leverage opportunities in the cash market. How much money I would have to shell out, part with if I would have gone in for a cash segment deal, right? So leverage factor is there available in the derivative products, which encourages speculative activities. Whether it's currency, whether it's anything, options are available. Write a call option on my shares in order to pocket the premium. When he wants to buy those shares, I have the shares, I will part with the option. I don't have any Reliance shares, but still I enter into the contract. From these particular transactions, particularly for retail investors, are much, much higher. What is the scenario in other markets? So 80% of the people lose money in future and option market so far as retail investors. One has to be very careful when you are doing swap transaction. There is a currency swap, there is a future swap. I mean, sorry, there is a commodity swap. Every swap transaction, I'll just explain in brief. I'll give one example for the paucity of time. There are, I mean, other types of swaps also available, but let me give one example to explain the concept of swaps. You know, there is a fixed term when that interest payment between fixed and floating would be done. Suppose it is a 3-year contract and it is to be settled 6 months. Every 6 months, there would be exchange of benchmark to a particular index, of course. It can be 6-month treasury bill or any other, whatever you have decided, right? Credit derivative products. Now, I will not explain in a very great detail, but and we must understand because so many, because when an issuer issues a debt, credit risk, counterparty risk is always there, irrespective of the rating. So how these credit derivative products, what are the main kind of products I will just explain. Credit investors. What happens is in the credit linked note, they will get much higher rate, right? In the credit linked notes, who are subscribing to the credit linked notes. So the credit risk passes from original investors to the investors of the credit linked notes. Correct? That counterparty, that is assumed by those. Why they are assuming? Because they are going to get as compared to the original contract. That is what you may call the premium that is being paid to those interest payments in respect of that particular credit linked note. But on maturity, I will get that particular amount back, provided there is no credit event or a credit default that has taken. A different terminology, but credit default swap is also, there is somebody who has actually taken that risk, who is willing to provide you the insurance. It is merchant insurance. That in case in the credit default swap, you have to continuously make premium payments over the prescribed periodicity, protection buyer to the protection seller in a credit default for the entire tenor of the loan. And the guarantee that he will get is that in case there is that loss will be then assumed by the. So that is how the credit default swaps instruments take place. Pool of individual loans, be it auto loans, housing loans, they are bundled into individual loans into a pool. Then they are sold to the investors. Now, how that works as a derivative? There is a senior tranche, there is a junior tranche. First to be paid would be always super senior or senior tranche. And one who is going to lose is the junior tranche. Why junior tranche? Because he is getting much higher. So depending upon which kind of investor you are junior tranche or a senior tranche. So this is always put into those brackets. And then those securities are sold in the market and accordingly. And then there would be debt holders. Debt holders amongst junior tranche would be the first one and senior would be the last one so far as those holders are concerned. Financial derivative products that are available. Now I will just explain certain basic things and then conclude because time is also going to be over. Just try to summarize in whatever limited manner I could explain. See, those who deal in foreign exchange, they are also foreign currency, they are also using these products. I am prepared to pay this premium, but I want to secure myself up to this level. This is called hedging, right? Okay, मेरे को profit हो ना हो, but I cannot afford to have these kind of unlimited losses. Not others also. Even bankers use derivative products. They have gone in for a fixed rate corporate bond they have raised. Fixed rate bond they have raised from the market. And they want to convert into floating. They will go in for interest rate swaps, right? They will go in for currency swap wherever they feel there is better. There would be always people who are risk takers and who are risk averse, right? And there are those who believe I don't want unnecessarily. So I am risk averse person. So those risk averse people, they say, okay, what is the loss? Loss is whatever I pay by way of an option. but losses can be unlimited. So they will be always, so long as risk averse and risk takers are there will be divergent view of the stock movement, stock price movement, that it is going to go up or it is going to come down. Some people will believe price of this particular agricultural commodity is going to go up. Some will say it will come down. Accordingly, they will take their particular positions. And this is how, but speculation, particularly for retail investors in this kind of futures and option markets, can be very, but as bankers, I would urge that we must encourage wherever possible, where there are importers and exporters, to always hedge huge losses and entire firms being wound up only because of the naked position that some people were carrying for carry a cash and carry trade that they were doing on certain, exotic option about which I have not talked. So we should be using it more for the purpose of hedging strategies rather than for the purpose of to ask any clarification, any terminology that is used that you may have read about, which you are not able to understand. Concept like there is a straddle strategy, there is a strangle strategy, there is a stab. I am not trying to confuse anyone. So basic forwards, futures, options, swaps, I have explained. These are the basic instruments. And of course, there are some credit derivative products which I have just shared. Anything that you want to know, you are most welcome to ask.
Thank you so much, Kalia sir, for that very insightful presentation on financial derivatives and risk hedging strategies. And I'm sure your expertise and clear explanations will be found useful by the participants. I'm sure there will be some questions also.
Yeah,
So we will have that questions also from the audience. But before that, we are very happy to have Shri Tangsale sir with us today, and I'll request him for his observations, and then we will move over to the question answer session. Over to Tangsale sir.
Last 1.5 hours, my God, hats off to you, Kalia sir, for a wonderful presentation. And you have covered almost everything in a very lucid manner, which a banker should know. The only caution word which all the participants should carry, that these instruments should be used for the risk hedging and not the speculation. I am sure all of us in the financial sector now talk about a VUCA effect. All bankers have to know that the financial sector is going through this VUCA, and thus you have to have the such instrument which will save you and which will give you your assured expected returns, provided you are using it for the risk for hedging purposes, for handling the exporter importers, or if you are handling any domestic, wherever you feel that you're so see that they get minimum or they get at least their expected assured return, they must get into proper hedging instruments. What your hedging instruments is useful out of this? What are the flow chart for each product showing counterparties and the underlyings and the flow. If it is explained through at least 5-6 slides, it will be extremely useful for the audience to absorb it. Because one listening, you need to read, you need to listen it again. And that is what is my suggestion to you. Thank you very much. All the very best.
Thank you, sir. We will be providing a summary and key takeaways of this.
Yeah.
And as regards flowcharts, I think I will not be able to make those flowcharts on my own.
I mean, we can just draw what are the diagrams, what is the counterparty, how they, that kind of, I mean, some charts can be drawn.
I think
Yes.
it's very easy to understand through the flow chart diagrams.
It's a very, I mean, unless and until we are actually doing, it's very difficult to understand and absorb. So many terminologies are there.
Madam Hemlata is there.
Yeah.
Please, madam, ask your question.
What I would like is another session exclusively on options, because options is one of the most difficult topics. And you have different the callers option, the callers and the flows and all of those things, those very intricate subjects. Another session on that also would be very useful, sir. Thank you so much.
But whatever is generally being talked about, I have tried to explain what is a covered option, what is a naked option, what is a call option, what is a put option, and what is option writer, what is a option. See, many times we get confused between when we talk, whether we are buying and selling is a different thing. So sometimes underlying gets confused with the option seller. That's not a.
Released by RBI towards the end of this month. So on second Saturday, we'll be having a session on that. Also, I'll try to prepare on the basis of that some do's and don'ts, and I'll send it to Kalia sir, because this is a subject about which I don't know much. So I will need the help of Kalia sir on these things before I circulate this to you. Because it was a very dry kind of a subject, and somehow he handled it within the 90 minutes that were given to him. And and of course, I thank Tangsale sir for the very valuable insights that he has given on today's session. With that, we come to end of today's session.